All right, hello everybody and welcome back to my channel. I hope everybody's having a really good weekend. This week we're actually going to talk about the differences between index funds and mutual funds. A lot of people have been asking me questions about this, so I wanted to make sure I got a video out there. For those of you who are new to my channel, my name is Paul Novak and I love saving, investing, and spending money, and that's what we're going to talk about today. If you like our content, and we post these financial education videos on Saturdays and then we do portfolio reviews on Wednesdays, I'd encourage you to smash that like button and subscribe. I'd also encourage you to post comments if you've got questions or topic recommendations. That's how we got to doing this video this week, and we respond back to all comments. If you're interested in getting started investing, I've got a lot of different links below. I'm not going to go through them all, but if you use any of those links, you can get free stocks and a lot of other free stuff. And then just please remember, I'm not a financial professional, right? I'm not affiliated with anybody. The only thing that I go over in these videos is stuff that I actually use and support myself. So with that being said, let's get into it. All right, so this week, like I stated, we're going to be talking about index funds and mutual funds. I'm actually going to break down what the difference is between the two, what the fees are associated with them, and actually compare what their performance is. And once I get through that, I am going to share the holy grail, what I think the best investment is for beginners and even seasoned investors alike. So stick around for the end of the video where I'm going to cover that investment. So as we go through this video, I really wanted to let you guys know my perspective, right? So I am a value investor. And when I say that, I'm really investing for long-term investment strategy, right? I'm not buying meme stocks. I'm not day trading. I'm not in it to make a quick buck. I deposit money and I hold on to my positions for a very long time, knowing that while the market goes up and down and can be very crazy, my investment should, over the long term, continue to generate wealth. So when I go through what I'm talking about today with index funds and mutual funds, just understand that I come from a point of holding on to those long term and not buying them and trying to get rid of them right away. All right, so let's talk about what is a mutual fund. I'm going to start there. And really, to keep this simple, because I try to keep my content based around beginners, a mutual fund is nothing more than a fund that holds on to stocks, bonds, and other securities. It's all packaged into one fund. And why people generally buy these is they buy them for diversification. Right? So instead of having to buy all your own individual stocks and individual bonds and all these other things, you can literally buy one fund, which is extremely simple, that's diversified in all of those different things. And people do that because you don't want to put all your eggs in one basket, right? You want to make sure that you've got it spread out so that if you do have any issues with any of those investments, you've got a lot of other ones to lift them up so that you're protected. So now if you look up at the screen next to me, and I absolutely love this picture, it's a really simplistic breakdown of what is a mutual fund, right? So the first thing with a mutual fund is when you buy that, it's designed to beat the market average, right? So you're hoping when you buy a mutual fund that its performance is going to be better than what the market does, and it's actively managed, right? So there is a brokerage firm that is paying somebody to pick the stocks that are in that fund, and that's how they intend to beat the average, because they're going to invest in companies that they feel will do better than what the market average is. But with that, you're going to end up paying more money for an actively managed fund. The expense ratios on it are going to be higher, and I'm going to go into that later on in the video. So now if we switch over to index funds, right, extremely similar topic to go through. An index fund, though, where its main difference comes in, is it's not designed to beat the market. It's designed to be the market, right? It's going to mirror the holdings that are in those market averages. And I always look at the S&P 500 index, right? So when you buy an S&P 500 index fund, it's designed to hold all the same companies that are in that index. And what that gets you is it's a passive investment, right? You're not paying somebody to go out and pick individual stocks and holdings to try and beat the market. Literally, it's just an index set up that if a company gets added to that index or taken out, the fund adjusts accordingly. You don't have to pay anybody to manage that. And what that ends up getting you is lower expense ratios, right? Because there's less work to try and upkeep with the fund. Therefore, the expenses you pay accordingly are less. All right, so now that we understand the difference between index funds and mutual funds, and right, the main thing that I want to focus on, one's actively managed, one's passively managed, so the expense ratios are different. I want to show how those expense ratios can really impact your investment. All right, so I already typed in the information just to make this a little bit quicker. I found this online calculator really cool, and I'm going to place a link to it down below. So if you guys want to use it yourselves, you can. The numbers I'm using for this is that of a Roth IRA. So for me, when I opened my Roth IRA, I had to start by putting $1,000 in it. I'm just going to assume we're going to invest in it for 30 years and that we can put $6,000 a year in, which is the max contribution limit now, and we're going to do that per year. This annualized rate of return, I've got at 13.38. I'm just going to show you where I'm pulling these numbers from. Right down here, as part of this calculator, they have annualized rate of return. And it states for the S&P 500 over the last 10 years, its annual rate has been 13.8. So that's where I got that in to put these numbers in up here. Just to kind of show the difference, I've got investment one at a 0% fee. So that's assuming, right, that we're not paying any expense ratios. We're going to get all the money we invest. The other one I've got at 0.09, which is, according to the data that I've shown, the average expense ratio for an index fund. And then I've got 0.082 here, which is the average expense ratio for a mutual fund. So when I go in, click calculate, and then I'm actually going to switch this over to view report. What I like is it's got the breakdown of the three here, right? So you can actually see it in graph form. You can see here how that blue line is showing no expense ratio at all, but that green line is not very far behind it. But now when you start looking at the mutual fund, right, that's quite a bit lower. And as I scroll down here just really quick, and I love this because I can see the difference between the fees, you can see all of this information is the same, but the annual return after fees, you can see where this actually starts to go down. And really the difference in this, using this example, right, if I got all the money, I've got $2.19 million, which is pretty good. With that ETF, or the index fund, because it's so cheap, I'm only down to 2.15, right? So I've still got $2.15 million. That's pretty good. Once I get over to the mutual fund, though, that small percentage drops me all the way to $1.85 million. So what you're paying here in expenses is pretty significant. And then if you actually wanted to look at the balance by year, you could do that as part of this calculator. I'm not going to get into all that, but it does just go to show how those expense ratios can cut into your profits. All right, so we just went through the calculator, and you can see how that actively managed investment can really cut into what your profits are. All right, so now that we've seen the two different investments and we've seen how mutual funds are more expensive than index funds and how mutual funds can actually cut into your profits, right? We assumed that everything was equal. And as I stated earlier in the video, the whole point of a mutual fund is to beat the market average, right? So if it's performing better, maybe that expense ratio isn't all that expensive. All right, so this is where things get interesting, right? And this message I want to send to people buying individual stocks along with mutual funds, right? Mutual fund managers are out there and they get paid a lot of money by huge brokerage firms to manage trillions of dollars, right? There's tons of money out there in mutual funds. And you'd think that if people are doing that and getting paid that much money, they have to be beating the index funds, right? But what's crazy is index funds continue to beat mutual funds, right? That is nuts because we already showed the expense ratio. We showed how much you're losing in profits. Now I'm here to tell you that while mutual funds are designed to beat the market average, they're actually losing. That doesn't make a whole lot of sense, but I'm actually going to put up on the screen here some statistics that I found online, and these were directly from CNBC, right? While 64.5% of mutual funds underperformed the S&P 500 index over 1 year, over 15 years, 91.6% of mutual funds lost. That is crazy. So again, why would you spend all those expenses? And I'm going to state, right, that's not every single mutual fund. Obviously, if I'm telling you 0.6% of them lost, that means at the end of the day, some of these mutual funds did beat the index funds, but again, the odds are not in your favor. And those are the real statistics. So at the end of the day, I've got friends and family that have, signed up for Robinhood or have brokerage accounts and are doing regular trades. And I'm not going to lie, some of them have significantly beat the S&P 500 in the short term. But I think that the statistics show that index funds over the long term are the way to go. So the last question I wanted to go over is, if index funds are truly so good, then why the heck isn't everybody just putting their money into index funds? And all I can say is I'm going to speak on behalf of myself. So when I started out investing, right, I didn't even know what an index fund was. And heck, that's why I'm making this video, to get this information out to others, right? If you don't have the education on how good index funds are, you don't know how to invest in them. And if you look at my portfolio, which I show on Wednesdays in my portfolio review, you're going to see that I have a lot of individual holdings, right? Not all my money is in index funds. And again, I think that goes back to the point that I made earlier. I didn't know about the index funds in the beginning. So, when I started, I bought companies like Apple and Amazon and big companies that I've heard a lot about, that I've heard the share prices went up a lot over time. And really the reason why I'm holding on to so many individual holdings versus having all that stuff in index funds is because I don't want to pay short-term capital gains on that. I've got another video, not going to go into all the capital gains rates now. If you want to click on it, you can, and I'll put it in the description below. But once I get those holdings to qualify for long-term capital gains, I will be trimming a lot of my individual holdings back and putting it in an S&P 500 index. And as I continue to learn more and doing these videos, my strategies for investing continue to evolve. Another reason why I think people don't put all their money in index funds is because it's boring, right? People that are investing, and I've learned this a lot from being in different Facebook groups and things of that nature, they want excitement, right? It's exciting to be in the next meme stock or to be in the cryptocurrency that's going way up in value. And I've seen individual stocks go up over a year's time 1,000%. Heck, some of them have gone up 100% in a day, right? And people like the excitement of trying to get in that. Sticking all your money into an S&P 500 index and letting it just sit there isn't exciting, right? Especially when you've got all these other people around you with, talking about, hey, they made huge profits in this stock, they made a bunch of profits in this stock, and then people start getting FOMO, right? Fear of missing out. When you see these people around you telling you these stories of making all this money, and they say, well, what are you invested in? And you go, well, I'm in an S&P 500 index. That's not that exciting. And people do think that they're smarter, right? That they can beat the market average. So they invest in individual holdings. But I think I've shown enough data in this video to let you know, over time, the index funds will do better. So when we're talking about hitting on an individual stock, the reason why I think it's risky, and not that it's not possible, is you have to be right 3 times consistently, right? You have to pick the right company that's going to go up in value. You got to buy it when it's low in price, and you have to know when it tops out so you can sell it when it's high in price. And I'm not saying that those things aren't possible, but I'm saying that if you're going to do that with tons of different company year after year after year after year, and you think you're going to hit on all that all the time, It's highly unlikely. So that's where I really recommend dollar cost average into an S&P 500 company or holding. Hold it for a long period of time and you're gonna be successful. And as I learned more about trying to create generational wealth and really build up my portfolio, the two things that I think are so critical is to have a plan, know what that plan is, and have the discipline to stick with it. Right? I'm investing in S&P 500 index funds, and I don't care if the market's going up, if the market's going down, what the heck is happening. I stay committed that every single paycheck I get, I'm putting money towards that, knowing that in the long run, we're gonna be successful. All right, and lastly, I didn't forget, I told you I was gonna tell you what I think the best investment is for beginners and seasoned investors alike. And if you haven't been able to tell as I've gone through this video, it is an index fund for the S&P 500. I think that is the way to go. What might surprise some of you guys, in a lot of my other videos, I've talked SPY, I'm always talking about that index fund, and it's because that's what I knew. In doing this video and doing more research, I've actually found out that VOO has a lower expense ratio than what SPY does. So, doing these educational videos, hopefully they're helping you. Heck, it's also helping me learn more. As I go in here, the other thing that I wanted to show you is how to find these expense ratios. So I'm actually going to pull up Morningstar and show you where you can find this information for yourself. All right, so here I'm going to actually pull up Morningstar and show you where I track my expense ratios if it's something I want to look at. There's a lot of different ways to do it. This is free online, so I thought it'd be something good for me to show. And as I stated, I also wanted to go over what I think the best investment is for beginners and advanced investors alike. So I'm going to search up here and type in VOO. And this is a Vanguard S&P 500 ETF. I think that this is the best investment. Something that I've actually learned from doing this video, because I used to invest in SPY. If you've watched my other videos, you've heard me talk about that one a lot. And the reason why I'm actually changing my tune to this VOO is because the expense ratios are lower. So both funds, SPY and VOO, they're both market average index funds that track the S&P 500, but SPY's expense ratios are actually 0.095. It's an older fund, it's got more money in it, but at the end of the day, the index funds are tracking the same market average. So for me, I'm actually going to be taking my money out of SPY once I hit long-term capital gains and switching it over to this VOO. And that's why the expense ratios is why I think it's the best investment. And you can see that right here. All right, just the last thing that I want to state is do not get overwhelmed with all these concepts and let it prevent you from investing. That's what I did, and it is my biggest regret when it comes to investing. If you're interested in getting started investing as a beginner, I'm going to post a link to one of my videos where I walk through all the strategies of how to do this with an S&P 500 index fund. Hopefully you found this information helpful as you have some of our other videos, and if you have, I encourage you, smash that like button and subscribe. If you have any comments, please place them down below. We respond to all comments. As I stated earlier in the video, got a lot of different links down below if you're interested in starting to save or invest. I say thanks for watching, and I'll see you back here next week to talk about saving, investing, and spending money. See you later.